Hello, this is Greg Ring, co-founder at Philanthropy Architects. We recently had a donor of a Christian university who was a faithful giver to this particular charity, giving out of her cash flow, out of her checkbook, less than $5,000 per year. But she and one of the major gift officers had become very close friends. They traveled together, went to wine festivals together, and so on. As we talked, the gift officer said, I think you could help her because she's mentioned they might be selling the company. So kudos to the gift officer whose antenna went up. I worked with this lady and the gift officer for about 2 years as they were getting ready to sell the business. There was a lot of developments during that season. A new product line had come out, and by the end of the 2 years, they actually had companies competing to buy this company. It was 35 years old. They'd been working as a family, 4 siblings working within the company together. This lady owned 1/4, 25% of the business. The business finally sold in an all-cash deal for $192 million. So her portion of that was $48 million. In the state she lives in, the combined federal and state long-term capital gain taxes are over 37%. So on $48 million, that was going to be about $18 million in taxes. This gal really enjoys giving to charity, and the idea of writing a check to the government for $18 million was not a happy thought. In one of our dinner conversations, I said, that's like 12 years of your life that you have worked to earn enough money so that you can write an $18 million check to the government. She said, that's an awful way to think about this. So in the course of the sale, prior to any binding contract, we moved her portion of the stock, her portion of the company, into 3 different components. 20% went into what's called a donor-advised fund. This is a tax-exempt environment that allowed her to sell that stock inside the donor-advised fund and pay no taxes. Plus, she got a fair market value deduction for that 20%, almost $10 million charitable income tax deduction. 30%, she sold directly to the buyer. She wanted some cash in hand to fulfill her inheritance goals for her 3 adult children. Over the course of our years talking about this, she decided that she wanted to give each of her children $5 million and the lake house that she owned. So we wanted to be sure there was enough left over after the sale to fulfill that. She had other assets, other investments, and combined, it would be enough to fulfill her inheritance goals. The final block, 50%, went into a tool we've talked about called a charitable remainder trust. Tax-exempt trust that provides current benefits coming back to her, but also allowed her to sell that $24 million worth of stock tax-free. At the end of the day, she ended up with almost $10 million in her donor-advised fund, money in her pocket to fulfill her inheritance goals, and $24 million in the charitable remainder trust, kicking off about $100,000 a month of income for her for the rest of her life. That money inside the charitable remainder trust is invested. We work with her money managers to invest that money. And when she passes away, the remainder, that's where the name comes from, will pass to various charities that she cares about. But as a result of our planning, her tax bill went from $18 million, where it would have been, down to just over $5 million. So we saved her $13 million in taxes, and maybe more important than the tax savings was she's having the time of her life giving away money to charities that she really cares about. As we're working with her financial advisors, the plan is that in a couple of years, when her 5-year carry forward is used up on that deduction, she may dip into that charitable remainder trust and drop another $5 million into her donor advised fund to replenish it, and she'll also get another additional charitable income tax deduction at that point. Now that's a pretty complicated case. I'm happy to go through it with you individually and just answer questions you might have. Let's see if this applies to your situation. If you think you might be selling a rental property or a farm or a piece of land or even a family business, let's have a conversation. Our team at Philanthropy Architects is skilled at just listening to your goals and then figuring out what applies and doesn't apply in terms of trusts and tools that Congress has put in place to encourage generosity. So hit the pause button and let's see if we can have a conversation, explore reducing or eliminating taxes that you're facing in exchange for giving to charities that you care about.